It's not just about what you make, it's also about what you keep, and that's really what matters. So today, we're covering 4 ways to reduce your taxable income, especially when it comes to investing. Hi, I'm Jeff Jr., and before we dive into the not so exciting but critical topic of taxes, our compliance officer would like me to remind you to speak with a tax professional and a fiduciary advisor before taking action on any of these ideas. You're welcome, Shane. First, holding on long-term is your friend. So, what does that even mean? When dealing with investments in general, it's essential to understand short-term versus long-term capital gains and the tax implications of sales. Gains on investments held for a year or less are considered short-term capital gains, and they're taxed as ordinary income. On the other hand, long-term capital gains taxes apply to investments held for longer than 1 year, and they're lower. An investor holding a capital asset for longer than 1 year enjoys a preferential tax rate of 0, 15, or 20% on the capital gain, depending on the income level. For 2021, the 0 rate bracket for long-term capital gains applies to taxable income up to $80,800 for married couples and $40,400 for single individuals. If your eyes are glazing over at this point, it's perfectly okay. A tax planner and fiduciary advisor can help you figure out when and how to sell appreciated assets or depreciated assets to minimize those losses. Now moving on, let's move on to number 2. Looking at the benefits of using tax-sheltered accounts like 401ks, 403bs, or an IRA for that matter. These offer the opportunity to allow your investments to grow before taxes. Now, that doesn't mean they're tax-free, but they are tax-deferred and will enable your portfolio to grow much more rapidly than it would in a taxable account. Moreover, you won't have to deal with tax considerations until you begin making withdrawals when you're retired. And the hope is that you'll be in a lower tax bracket at that time. Now don't bet on it, but at least there's hope. Number 3, max it out. Yes, we've recommended this before and we're at it again. Max out your retirement account contributions. This is a great forced savings plan. In 2020 and 2021, taxable income can be reduced for contributions up to $19,500 to a 401k or a 403b plan. Those 50 or older can add $6,500 more to the primary workplace retirement plan contribution. So for example, an employee earning $100,000 in 2021 who contributes $19,500 to a 401k reduces taxable income by that amount to only $80,500, which is a great benefit. Now 4, consider municipal bonds. Buying a municipal bond essentially means lending money to a state or a local government entity for a set number of interest payments over a predetermined period. Once the bond reaches its maturity date, the total amount of the original investment is repaid to the buyer, which is you, the investor. Interest on municipal bonds is exempt from federal taxes and may be tax exempt at the state and local level as well, depending on where you live. Tax-free interest payments make these very attractive. However, municipals typically pay lower interest rates. But because of the tax benefits, municipal bond tax equivalent yield makes them attractive to investors. The higher your tax bracket, the higher your tax equivalent yield. I could keep on going from HSAs to real estate investments. There are ways to reduce most tax burdens or at least keep them to an absolute minimum. Now, to really make sure that you're reducing taxes, talk to a professional like those that we have here at Trajan Wealth. Not only will you get help on tax planning, we can also help with your retirement planning, insurance, and estate planning such as trusts and wills. Visit us online and book a complimentary consultation today. So until then, take care.